What is financial leverage? Financial leverage is the relationship between assets, the returns those assets generate, and the way they are financed. It's a powerful tool, but also a dangerous one. Today, let's break it down with a simple story. Let's start simple. Imagine a factory with $1 million in assets, buildings, machines, and inventory. These assets generate $100,000 in net income every year. That gives us a 10% return on assets, ROA. And since everything is financed with equity, return on equity, or ROE, is also 10%. So far, so good. Pretty straightforward. But here comes the interesting part. Equity isn't the only way to finance assets. What if the company decides to borrow money from the bank and finances 50% with debt and 50% with equity? Now we have to account for interest costs. Net income drops to $80,000. That means ROA equals 8%, but ROE equals $80,000 divided by $500,000 equals 16%. Notice what just happened. Even though ROA went down, ROE went up. That's the magic and the danger of financial leverage. Let's push this a little further. Scenario 1, 20% equity and 80% debt. Net income falls to $68,000. Return on assets, 6.8%. ROE, a stunning 34%. Scenario 2, 10% equity and 90% debt. Net income drops again, this time to $64,000. ROA, 6.4%, but ROE skyrockets to 64%. So the more leverage we take on, the higher the ROE. On paper, it looks like a dream. But wait, real life is never as neat as the math. What happens if the factory suddenly has a bad year? Instead of earning $64,000, imagine the company loses $200,000. With high leverage, that loss doesn't just hurt, it wipes out all the equity. At that point, shareholders must urgently inject more money, or the bank will seize the assets used as collateral. This is why financial leverage is called a double-edged sword. It can multiply gains in good times, but it can also destroy equity in bad times. So the lesson is clear. Financial leverage is powerful, but it must be handled with care.